They didn't just sell silver, they smashed it. In less than 90 minutes, silver dropped from $87 to $75, wiping out billions on paper before most people even realized what was happening. No breaking news, no warning, just a sudden, violent move that left everyday investors frozen while someone else walked away richer. And if you think this was random or just market volatility, then you're about to miss the real story, because what happened to silver wasn't an accident. It was intentional. It's happened before, and it will likely happen again. Before we go any further, if you care about understanding what really moves markets, not the headlines but the forces underneath them, make sure you like this video and subscribe to the channel. Here on Finance and Global Economy, we break down how money, power, and timing shape your financial future, in plain English, without the noise. Subscribing now helps you stay ahead of moves like this, instead of reacting after the damage is already done. Now, let's talk about that 90-minute crash. Silver didn't slowly drift down. It didn't roll over on bad economic data. It collapsed in a straight line, as if a trapdoor opened beneath the price. That kind of move doesn't come from normal buying and selling. It comes from size. It comes from players who can dump massive positions all at once, knowing exactly where the stop loss orders are sitting, knowing how thin liquidity gets at certain moments, and knowing that panic will do the rest of the work for them. Here's what most people don't realize. The silver market is relatively small compared to stocks or bonds. That makes it easier to push around. When large institutions or funds decide to unload paper silver contracts in huge volumes, especially during low liquidity windows, prices can fall fast. And when prices fall fast, automatic sell orders kick in. Margin calls hit. Retail traders are forced out. The cascade accelerates. What looks like chaos on the chart is actually a very clean transfer of risk from weak hands to strong ones. And this isn't new. Silver has a long history of sharp, sudden crashes that make no sense if you're only looking at supply and demand. Physical silver doesn't disappear in 90 minutes. Industrial usage doesn't collapse in an hour. Jewelry demand doesn't evaporate before lunch, yet prices move as if the world just changed. That's because the paper market, not the physical one, sets the price in the short term. Futures contracts, leverage, and derivatives decide what you see on the screen, even if nothing changed in the real world. Think about the psychology here. When silver was running toward 87, excitement was everywhere. Social media was full of price targets. New buyers rushed in, afraid of missing out. That's exactly when the market becomes vulnerable. When optimism is crowded, the downside risk increases. Large players know this. They wait, and then, when positioning is just right, they strike. The goal isn't just to push prices down. The goal is to scare people out, because fear is cheaper than force. You don't have to sell forever. You just have to sell enough, fast enough, to trigger panic. Once fear takes over, the market does the rest. Retail investors sell at the worst possible moment, not because they want to, but because they feel they have no choice. And that's where the real money is made. Not during the run-up, but during the forced exit. This is why silver feels different from other assets. It's emotional, it's volatile, and it's heavily influenced by expectations around inflation, interest rates, and the US dollar. When bond yields move, when the Federal Reserve signals tighter conditions, or when the dollar spikes, silver becomes an easy target. Even if the long-term story hasn't changed, the short-term pressure can be brutal. And here's the uncomfortable question most analysts won't ask. Who benefits from these crashes? It's rarely the small investor. It's the institutions with deep pockets, strong risk management, and the ability to wait. They can sell high, trigger the drop, and then quietly rebuild positions at much lower prices. To them, volatility isn't danger, it's opportunity. If you're still watching right now, this is where it gets important, because understanding this pattern changes how you approach silver entirely. Instead of chasing price spikes, you start respecting timing. Instead of panicking during crashes, you ask who's selling and why. And instead of assuming markets are always fair, you recognize that fairness has nothing to do with it. Markets reward preparation, not emotion. That doesn't mean silver is a bad asset. It means it's a dangerous one if you don't understand its nature. Silver moves fast in both directions. It can outperform dramatically and then punish just as quickly. Long-term holders often believe in silver as protection against inflation, currency debasement, and financial instability. Short-term traders, on the other hand, are playing a very different game, one where speed and discipline matter more than belief. The 90-minute crash from 87 to 75 wasn't the end of the story. It was a chapter. And what usually follows chapters like this is consolidation, confusion, and silence. The headlines move on. Attention fades. That's when positioning quietly changes again. The people who were forced out swear never to touch silver again. The people who understand the cycle start paying attention. And this is why conversations like this matter, because if you only learn about moves after they happen, you're always reacting. But when you understand the mechanics behind the moves, you stop being surprised. You may not predict the exact minute of the next crash, but you recognize the setup. You respect the risk, and you don't let fear make decisions for you. If this perspective is helping you see the market more clearly, don't forget to support the channel by liking the video and staying subscribed. It tells the algorithm that deeper conversations like this matter, and it helps finance and global economy keep bringing you analysis that goes beyond surface-level news. As we wrap up, I want you to think about one thing. The biggest losses in markets don't come from being wrong about the long term. They come from being forced out at the wrong time. Silver didn't crash because it suddenly became worthless. It crashed because someone needed it to. And next time, the move might look different, but the logic behind it will be the same. If you've ever held silver, traded it, or are thinking about getting involved, I want to hear your experience. Did this crash surprise you, or did you see it coming? Drop your thoughts in the comments below, because these discussions help everyone learn faster. And if you found this breakdown valuable, share it with someone who still thinks markets move purely on news and fundamentals. Sometimes, the most important moves happen quietly, and understanding them is what separates panic from preparation.